Every macroeconomic, actuarial, and wealth model built in the last century relies on a single fixed constraint: human mortality. That static baseline is becoming a variable. This chart tracks the historical shift in that baseline. In just the last 50 years, global life expectancy has increased by 10 full years. When the foundational economic constant moves this rapidly, it forces a complete reassessment of risk models. Biological variance now represents the primary systemic risk to institutional wealth management. Leading capital allocators are already pricing in a future defined by these shifting biological timelines. This chart shows the scale of the capital shift. The combined allocation across general AI and AI-driven biotechnology now exceeds $400 billion. These specific sectors are seeing annual growth of over 20%, driven by a massive inflow of institutional capital. Allocators are treating human biology as a core infrastructure asset, moving significantly beyond the scope of traditional pharmaceutical investing. Institutional capital is now underwriting aging as an engineering problem with an exploitable return on investment. Biological research was historically an analog, trial and error process, restricted by high physical friction and slow feedback loops. This diagram illustrates the technological integration overcoming that friction. Computational models from Google DeepMind, Amazon, and Apple are now directly decoding biological systems. Systems like AlphaFold have already decoded over 200 million protein structures, providing the raw data for a new generation of medicine. This chart shows the resulting collapse in the cost of biological data. Genomic sequencing costs have plunged from $100 million in 2001 to less than $200 today. Digitizing biology creates a deflationary environment for data, allowing research to move at a computational pace. This data is now being applied directly to clinical outcomes, beginning with automated diagnostics. This data compares human diagnostic error against machine precision. In specific radiological diagnostics, AI achieves over 90% accuracy, significantly reducing the human error baseline. This precision is accelerating drug discovery, bypassing traditional pharmaceutical timelines. This timeline comparison illustrates the compression of Phase 1 through Phase 3 trials. The traditional 12-year development cycle is shrinking to just 3 to 5 years. Computational biology is accelerating the arrival of the longevity horizon by reducing time to market for life-extending therapies by a factor of 3. These accelerating technologies target high vitality years, moving the focus away from terminal end-of-life care. This chart defines the expansion of health span, the active, high-consumption years of life. The 21st century projection moves the baseline from 55 healthy years to 85 healthy years. Maintaining this engineered health span requires a commitment to continuous, high-cost medical maintenance. The linear model of biological decline is being replaced by an era of extended, high-vitality life. This biological revolution creates a new economic reality. An active life requires capital. This equation shows the new capital requirement. Extended health span combined with advanced medical costs leads directly to exponential capital demand. This comparison illustrates the failure of legacy decumulation models, which assume a 20 to 30-year retirement with static end-of-life costs. Today's reality requires a 50-year drawdown period, compounded by the exponential costs of continuous biological maintenance. This chart shows the widening mismatch zone between static financial planning horizons and the expanding biological lifespan curve. Almost every single standard actuarial model mathematically fails when subjected to the maintenance costs of this new biological reality. Wealth managers historically optimize for portfolio volatility to protect against transient market cycles. Standard volatility protection fails to address the permanent structural risk of a duration mismatch. This graph illustrates the failure point. If life extends just 20% beyond original projections, the decumulation model breaks down. At year 85, the capital line drops below zero, creating a severe capital deficit while life continues toward year 105. This poses the critical macroeconomic question: what happens when life extends beyond capital? As an institutional allocator must now ask if their proprietary frameworks have actively calculated this mismatch against their own client databases. Fiduciary responsibility in the 21st century requires protecting the capital timeline from the biological revolution.